Hello everyone. I'll just go through the problems one by one. So let me check one. Okay, so for the first session, I am just going through this problem. So tables are made of wood that costs $100 per table. So this is direct material, product, and variable. This is going to be direct material, product, and variable. The tables are assembled by workers at a wage cost of 40 per table. So this is going to be direct, labor, product, and variable. Or it won't be in product. Yeah, it will be in product. So workers assembling the tables are supervised by a factory supervisor who is paid 38,000 per year. So this won't be direct. So indirect and period and fixed. So yeah, it's indirect manufacturing overhead to be exact, product and okay, it's product. Hmm, I guess I don't know. Electrical costs are $2 per machine hour. 4 machine hours are required to produce a table. So this should be indirect and then product and variable. Yeah, okay. Okay, I can see it here. I want The depreciation on the machine used to make the tables totals $10,000 per year. The machine have no resale value and do not wear out through use. So it's manufacturing overhead, it's fixed, and it's period or product, and it's sunk also. Yeah. So the salary of the president of the company is 1 lakh. It is fixed. It is overhead and it is period. Yeah. The company spends 250,000 per year to advertise its product. It is indirect, so overhead, manufacturing overhead to be exact. And it's fixed, and it's period. Yep. Then salesperson are paid commission of $30 for each table sold. So this is also going to be uh, variable, variable product, I guess, and manufacturing overhead. Okay, it's periodical. I'm not sure why it is periodical because it's variable, but whatever. Variable, yes. I have no idea why it's period. Step production, this is opportunity cost right here. Problem two. So we want to look at this. Now 200 units, 1,000 rupees, 20% discount, 200. 800 is the effective cost. And IGST is 12%, 96, and packing charges are 50. So a 12% cash discount will be given if payment is made in 30 days. So this will be in not, we won't take this because it is something like if we are giving the money beforehand, it will be like interest we are gaining on that money for the 30 days. So it's not related to the product. Documents sustaining payment of IGST are enclosed for claiming input credit. Means the IGST you don't have to pay. Somehow I don't know why. I forgot. Compute the unit price of the material procured. So total cost is 850 for the packaging, so 850, and 200 units, so 850 by 200, which is to be 4.25, I think. Yes. So now this question, ineffective working seal days a week, 8 hours a day, a worker is paid at the rate of 100 rupees per day as basic, and 120, it should be 120 of basic as DA. He is allowed to take 30 minutes off during his hour shift for meal and break, and 10 minutes recess for rest. During a week, this does not during a week, his card showed that his time was rechargeable to. Okay, so I'll just try to do it. So 100 is paid per day, 100 rupees for basic and 120 for DA. So 220 per day he is getting paid. So every day he works for 7 hours 40 minutes. Okay, so where was I? Yeah. So 7 hours 40 minutes he works every day. I'll just type it down. So it's 7 hours 40 minutes, and he works 6 days a week. So during a week he works for 40 by 60. Sorry, 20 by 60. This would be 7 hours 20 minutes because he has 40 minutes off, which is around 7.33 hours per day. Now in a week he works for into 6, 44 hours. In 44 hours we pay him in total 48 hours. We pay him 220 into 48, right? So actually for working we pay him per hour 240 rupees. Okay, now in this 44 hours for X he did 15 hours, so it will be into 15, Y it will be 12 into 12, 13. So 240 into 13. So this will be the cost associated with the each job, and whatever is left equals to 960, or we can say 4 hours, which is wasted in between the job. So we, yeah. So okay. Mm, mm, mm. Where was I? Where did I go wrong? Wage rate per hour. Okay, sorry. Okay. This is 40 hours a day, and he gets paid 220 per day, not hour. So the total should be 220 per 6 day, right? Because 6 days a week. So 1320 will be the total and 30. Okay. So the total cost would be for 8 day, sorry, 6 day and 220 per day. So in total 1320 rupees. Anything else? Problem 4. Number of units sold 50,000. Selling price per unit 13. Variable selling cost per unit 3. Variable admin cost per unit 2. Total fixed cost 36,000. This and this and that. So normally we do profit and cost as revenue is addition. Okay. So revenue is 13 into 50,000, which is this much. Now cost of goods sold. There is no point of doing this, I guess. Uh, should I do it from blank? I don't know. I'll just go through it. And after that, to calculate gross margin, we need COGS. So the COGS is variable selling cost per unit is 3. So uh, sorry, number of variable selling cost. Yeah, so COGS is how much material we consumed. So that will be opening balance inventory plus purchase of inventory minus closing balance inventory. So 75 plus 21 is 96 minus 15 is 81. Okay. Yeah, so we'll get gross margin, and from that gross margin we have to calculate uh, selling cost per unit is 3 into 50,000. So wait a minute. Selling cost is 36,000 and 45,000. Okay, this, sorry. Fixed selling cost is 36,000. Variable selling cost is 3 into 50,000, 150,000, and plus 36,000 is 186, which is total selling cost, and admin cost is variable admin cost is 2 into 50,000, 1 lakh plus 45,000, 1 lakh 45,000. And if you total it, 331 is total AZ and A expense. Subtract it from 569, you will get net operating income. And in cost sheet, what we have to do is we have to do differently is this 650 will be revenue and COGS will be 81,000. But with COGS, we also have to calculate the other variables to variable cost we have to remove to calculate the contribution margin because contribution margin is revenue minus variable costs. So COGS is also variable cost, and the selling variable cost, which is 3 into 50,000 is 150,000, and admin cost 2 into 50,000, 1 lakh is also variable cost. So deducting it from the revenue, we'll get contribution margin. From that fixed cost 36 and 45, if we remove, we'll get net operating income. That is the difference between the term 1 and term 2. Okay. Okay, so for session 2, I'll just go through how I solved it, and then I'll check with what ma'am gave us as solution, and I'll check if it is correct or not. So contribution forward income statement for 1,000 units, the relevant range of production is 500 to 1500. Sales is 20,000, variable expense 12,000, contribution margin 8,000, fixed expense 6,000, and net operating 2,000. What is contribution margin per unit? Contribution margin is 8,000, so per unit will be 8,000 by 1,000, 8. What is contribution margin ratio? Contribution margin ratio is 8,000 by 20,000 because contribution margin ratio means contribution margin by sales. So yeah, and then what is what is variable expense ratio? variable expense ratio is variable expense ratio is, let me check what memory. What is variable expense ratio? Okay, it should be 60%, right? I don't know what I did. Okay, this is variable. Yeah, that's right. Variable expense ratio is 1 minus contribution margin ratio. You can do it in one way, like this by this. Or what you can do is variable expense how much? Its ratio in the sales. So 12,000 by 20,000. So yeah, that's what I did. And then what is if sales increase to one unit, what would be the increase in net in operating income? So if one unit is more, we will have contribution margin as 8,008 and fixed expense will be same. So the net profit will be increasing by 8. So that is common sense. And the fifth one, if sales decline to 900 units, what would be the net operating income? So if it is 900 units, so contribution margin will be less, 100 less, so 800 less. So new operating, and this will be same. So new operating income will be 2000 minus 800, which is 1200. If the sales price increases by $2 per unit and the sales volume decreases by 100 unit, what will be the net operating income? Okay, so what I have to do is $2 per unit. If selling price is $2 per, increases $2 per unit. So now how we are selling it is 20,000 per 1,000 units, so 20 per unit. So in case of 20, it will be 22, we are saying, right? And so if it is 22, variable expenses will be 12 per unit because 12,000. So contribution margin will be 10 per unit and decreases by 100 unit. So 900 unit. So 900 unit and 10 per unit. So 9,000 total our contribution margin. Okay. So 9,000 and fixed expense will be same. So net operating income will be 3,000 because 9,000 minus 6,000 equals to 3,000. Okay. If the variable cost per unit increases by 1 and spending on advertisement increases by 1,500 and unit sale increases by 250 unit. So first of all, variable cost per unit increases by 1. So in case of 12, it will be 13. So price will be 20, variable cost will be 13. Spending on advertisement, so fixed cost also will increase by 1,500. So first of all, how much unit? Units increase by 250. So contribution margin is 7 per unit and total is 1250. So 1250 into 7 will be the new contribution margin, which will be 1250 into 7, 8750. And now the fixed expense was 6,000 and with that 1,500 is increased, like so 7,500. So total net income will be 6,000 plus 7, 1,500, 7,500. We have to deduct, so 1250. So yeah, this is the answer. So what is the break-even point in unit sales? So break-even point means when the net operating income will be zero. So when it will be zero, when the contribution margin and fixed income, fixed expense will be zero. We cannot change fixed expense, right? What is the break-even point in unit sales? We can change the sales number and corresponding this unit actually basically. So what is the break-even point in unit sales? So for that, what we have to do is we have to check where contribution margin will be 6,000. We know contribution per unit is 8, right? So how much unit we have to sell is 8 into x equals to 6,000. So x equals to 6,000 by 8. So you have to sell 750 unit at least. So this is the 750. And what is break even point in dollar sales? So if you have to sell 750 and parcel it is costing 20, so it will be 750 into 20, which is 15,000. How many units must be sold to achieve a target profit of $5,000? So the target profit is $5,000. So net profit operating income should be 5,000. So for that, what contribution margin should be? Because fixed expense is 6,000. So contribution margin is, let's say, X. So we want X minus 6,000 to be 5,000. So X should be 11,000. So when X will be 11,000, if per unit it's 8 rupees. So let's say Y unit we need. So 8 into Y should be 11,000. So the total, how much it should be is 11,000 by 8. So 1375. Yeah, it's 1375. What is the margin of safety in dollars? What is the margin of safety percentage? Margin of safety in dollars is uh, I guess it is should not be margin of safety in dollars is C4 minus K21. K21 is break even. Okay, from break even, how much more we are selling? That is margin of safety. So margin of safety is we had to sell for break even 15,000 and we are selling 20,000. So how much more we are selling? 5,000, that is margin of safety. And what is the percentage? 5,000 by 20,000. Sales will be in the denominator. What is degree of operating leverage? So degree of operating leverage is ratio between contribution margin and net income, operating income, right? Yeah, that is degree of leverage, if which means if the contribution margin is what 8,000, the net operating income is four times of it. So using a degree of operating leverage, what is estimated percent increase in net operating income of a 5% increase in sales? So if the 5% increase in sales is there, how much the net operating income will change? So the easy formula is 5% into 4 equals 20%. And if you want to know how I did it, so if the sales is increased by 5%, so 20,000 into 5%, right? It is gonna be increased to 20,000 into 1.05. So this will be the new sales. And variable expense will also change with in the same because the sales unit has increased. So now we are selling 1050 unit, right? And per unit $20, so 21,000 is our revenue, and 12 per unit $12 is variable expense. So 1,015 to 12 is 12,600 is our variable cost. So our contribution margin is 8,400, fixed expense is 6,000. So operating income is 2,400. So how much it is increased from 2,000 is 400. So the percentage is 400 from 2,000, right? So which is 0.2. So which is basically 20%. Assume that the amounts of the company's total variable expense and total fixed expense were reversed. Assume that the amount of the company's total variable expense and total fixed expense were reversed. So variable expense 8,000, variable expense 6,000 and fixed expense 12,000. In other words, yeah, under the scenario, assuming the total sales remains the same, what is the operating leverage? So here it will be 6,000 So here it will be 14,000 and here it will be 12,000. It will be 2,000. So 14,000 by 2,000, which is 7. That will be our operating leverage. And if 7 was our operating leverage and we are increasing 5%, then it will be 35%. Or you can do in this way that if 1,050 is our new this and $20, so revenue will be 21,000. Now variable expense changed to 6,000 means 6 per unit. So total will be 6 into 10, 10,500, 1050, right? So 21,000 will be the this and 6 into 1,050 will be our variable. So our contribution margin will be 14. Okay, sorry. Yeah, 14,700 and fixed will be 12,000 because it's reversed. So now our operating net income is 2,700. So 700 increase. So 700. Why previously it was 2,000, 700. So it will be 35%. Okay, problem 6. Garlic Enterprise Distribution, a single product whose selling price is $24 per unit and whose variable expense is $18 per unit. The company's monthly fixed expense is $24,000. Prepare a cost volume profit graph for the company up to sales level of 8,000 units. Estimate the company's break-even point in unit sales using your cost volume profit graph. I have not done this. I have done this. How to calculate the break-even point. So its contribution margin is $6 per unit, right? 24 minus 18. So divided by the fixed cost, 24,000 by 6, this is 4,000. That is your break-even point. Now, the graph, I think I should look at how our ma'am solved it. Okay, okay, what is this? Okay, selling price is 25, variable cost 80, contribution 6, fixed cost is 24,000. And she did it for four, points 0, 2,000, 400, 4,000, 6,000, and 8,000. And they are calculated the selling point and everything and then calculated where it is crossing. Okay, understandable. Coming to session 3. K Limited sold this much units of its product at rupees 36, 7.5 per unit. Okay, so I'll just pause it and read it, I guess, because I don't want to make the video long enough. Okay, so now I have read it. So contribution margin you have to calculate. 37.50 is selling price and 1750 is our variable cost. So per uh, unit, the contribution margin is difference of it $20, right? And the fixed cost is 35 lakh. So break even sales is 3500 by 20, 175000. And it is in unit, and if you want it in dollar, just multiply it in the selling value. So you'll get this. Now it is said that cash break-even sales, where we need to calculate how much cash or how much fixed cost is going through our cash. So there won't include the depreciation. So there the depreciation will be 35 lakh minus 15 lakh, which is 20 lakh. So for 20 lakh fixed cost, if it is 20 lakh here, then what will be the cash break-even sales? 20 lakh by 20 this month, and amount will be into 37.5. Problem 8. A limited sales to product J and K. The sales mix is 4 units of J and 3 units of K. The contribution margin, I'll just delete it. Contribution margin per unit are 40 rupees per J and 20 rupees per K. So the sales mix is 4 is to 3. So we can sell it in 7. In a bulk, if you are selling 7 unit, there will be the total contribution margin will be 4 into 40, 160, 60 plus 20 into 360. So per 7 unit sales, the contribution margin is 220. Fixed cost are 616000. So total we need 616000 by 220. So 2800 of 7 batches. This is like a batch of 7. So total break evens. So total 2800 batches we need to sell. In 2800 batches, how in every batch 4 unit of J and 3 unit of K is there, right? So for J it will be 2800 into 4, 11,200, and for K it will be 2800 into 3. So these are the total uh, BP for J and K, and in total it will be sum of these two. 9,600. I guess it is correct. Yep. Problem 9. A company's PV ratio is 40%. Compute by what percentage must the sales increase to offset 20% reduction in selling price? Now these things are given, I guess, in the question. Sure. Okay, nothing is given. Okay. Okay, so I have, or these were taken. I am not sure if it was given in the question or not. I'll just check once. Okay, so nothing was given actually. Sorry. So nothing was given. So what I did is, if I remember correctly, so PV, a company has PV ratio of 40%. So contribution margin is 40%. So I have taken that, let's say sales is 1000. You can take it 100,000, anything like that. So as contribution margin is 40% given, so contribution margin is 400, and variable cost will be the difference of both, 600. Now they have said the compute by what percentage must sales increase to offset 20% reduction in selling price. Now selling price has dropped to 20%, right? So if we sell the same amount, our sales will be 800 rupees, and variable cost will be same. So the contribution margin will decrease to 200, right? So and the you know ratio will be in 0.25. Okay. So but we don't want to change the PV ratio. PV ratio means contribution margin by our sales. We want to keep it zero point 0.4. So if we want this to be zero point 0.4, so our contribution margin should be zero point 0.4 into sales, right? So using this equation, we have to calculate how much the sales would be, so that, and variable cost will be also increasing in that manner, right? So what I did is for sales, let's say we were selling 100 units previously, and per unit was costing 10 rupees, and per variable cost was 6. So I'm not sure if it is going to help you. So quantity was 100, variable cost was 6, selling price was 10. So previously, and now new selling price is 8. Now what we have to do is, and variable cost is still 6, and we have to calculate what is the quantity, right? Right. So we want our contribution uh, PV ratio to be 0.4. So, okay. So this was the old price, this is the new price. Need to change by how much? And so if it is 800 and it is 600, contribution margin is 200 and this is 200 by 800, 0.25. Now how much we have to sell so that in the same ratio it should increase, right? So let me check once. Sorry, I read the question wrong. So 40% PV ratio and it will be 0.25, the new PV ratio. So I don't want this to be zero point 0.4 actually. It has said that compute what percentage must sales increase to offset 20% reduction in selling price. So we don't want this zero point 0.4 to be zero point 0.4 again because now the contribution margin has changed. It will always be 0.25. What we want is this contribution margin to be previous, same as the previous. So if contribution margin per unit previously was 4 rupees and we had to sell 100 units for getting at 400. Now it is 2 rupees per unit. So we have to sell to get same 200 units, right? Because 2 into 200 equals to 4,400. So we need to sell 200 units. Now, how much we have increased the unit? We have to double the unit selling unit. So if how much unit we have to increase? 2x unit we have to sell. And what will be the new selling total revenue? As the new selling price is 8, it will be 8 into 200, which is 1600. So total revenue will be increased by 1.6 and total unit sales will be increased by 2x. I don't know how ma'am did it. Let's check once. So assume, okay, we are taking the same assumption. I think I have taken like that only. I'm not sure. What are these? I'm just gonna ignore it. Okay, problem 10. XYZ 8 lakh, 50%, 40% margin of sales as a total. Margin of safety, the total percent of total sales. Margin of safety means how much more we have sold from the break-even point by sales, right? Right. So there has been substantial sales in first person here due to the restructuring of the company could maintain sale quantity level of year one by reducing selling price. We are required to calculate sales for year two in value, fixed cost for year two in value, and BES for year two in value. So previously at year one, the sales were 8, 8 lakh and PV ratio was 50%. So variable cost was half of 8 lakh, 50% of 8 lakh, which is 4 lakh, right? And margin of safety means margin of safety means sales minus BP by sales, which was zero point 0.4, right? So from that we can see that BEP, just solve the calculation, BEP equals to 0.6 of sales. So BP equals to zero point 0.6 of 8 lakh, which is 4.8 lakh. So this 48, 400, 480K. So the BP is 480 000. So this is break even point. So break even point, this much of sales we have to do, right? Now they have said that the PV ratio have decreased to 37.5. So variable cost is 0.375. So now PV ratio means contribution margin. Contribution margin means sales minus variable cost by sales, which is now 0.375. Now they have said that sales quantity fixed is same, right? There has been substantial savings in fixed cost in year two. The company could maintain its sales quantity level of year one by reducing the selling price. Okay. So here the variable cost will be same as previous because the quantity is same and variable cost has not decreased. So variable cost will be 4 lakh again. So sales minus 4 lakh by sales equals to 0.375. So if we calculate it, it will be around equals to 1 minus 0.375 equals to 4 lakh. So the total sales in the next year will be 6 lakh 40,000. Okay, so 6 lakh 40,000 is our new sales. And the margin of safety here is, as a total percent of sales, is 21.88. So sales minus BP by sales equals to 21.88. We know sales as 640000. So if we calculate it, it will be around equals to 1 minus 78.13%. So BP will be equals to 625000. Sorry, what was the our sales amount? 6400, right? Okay. This into this. So our new break-even point is this amount. Okay, and fixed cost for year two in value. So fixed cost is the break-even point sales minus. Okay, so now if we sell 5 lakh, the net income will be 0. And in 5 lakh, we know that variable cost is 4 lakh. So contribution margin is 1 lakh. No, sorry, my bad. In con if we are buying selling 6 lakh 40,000, we are contributing 4 lakh variable cost. So the contribution margin is 2 lakh 40,000. Right, right. So we have to calculate in BEP what is the contribution margin, right? Right. So if we are selling 6 lakh 40,000, our contribution margin is 2 lakh 40,000. So if we are selling 5 lakh, what will be our variable cost? Our variables cost will be PV ratio means contribution margin. So variable cost is equals to 1 minus our contribution margin. This is our variable cost percentage. So here the variable cost will be 5 lakh into, sorry, into 62.5. So our contribution margin will be this minus this. So this is our break-even fixed cost for year 2. Okay. And sales for year 2 in value is 6 lakh 40,000. And BEA's break-even sales for year 2 in value is 5 lakh. Let's match the answer. 6 lakh 40,000 sales, 5 lakh BEA's value, fixed cost is 87,000. Yep, done and dusted. Now let's go to problem 11. Yeah, just go through this one by one. An increase in the physical sales volume by noting PV value will increase or PV value will decrease or PV will not change. Okay, PV won't increase if we are increasing the value. It's ratio, right? An increase in fixed cost won't change the PV because PV comes before. A decrease in the VC variable cost per unit will increase the PV ratio. Decrease in the contribution margin means VC increased, so decrease in PV ratio. An increase in the selling price per unit will increase the contribution margin, resulting in increase in PV ratio. A decrease in fixed cost does not have anything to do with PV ratio. 10% increase in both selling price and variable cost per unit. 10% increase in both will not change anything because it's the ratio, right? 10% increase in selling price per unit and 10% decrease in physical sales volume. 10% decrease in physical sales volume won't do anything, but 10% increase in selling price will increase because this 10% decrease in volume has nothing to do with PV ratio. 50% because it's sales amount by variable cost amount and by total sales. So this is the formula. So if we are physical sales volume is decreased, it will decrease from sales also, variable cost also. So no point. But in 10% increase in selling price will increase the sales in that, and variable cost won't be changing. So total will increase. A 50% increase in variable cost per unit and 50% decrease in fixed cost. Again, 50% decrease has nothing to do with this, but 50% increase in variable cost means the total will be decreasing. So decrease. A company. Okay, I'm not going to do it from scratch. It's too long. I'll just explain how I did it. So these are given 100, 120, and 80 variable overhead per unit, 8, 20, 12 for department A rate per hour is 4, for department B rate per hour is 8, and hours per unit is needed for A and B, and annual production present in units is 10,000, 12,000, 20,000. 312, 400, 400, 240 is estimated selling price and sales department estimate of possible sales in the upcoming periods. Now we have to calculate first contribution margin per unit, which is selling price per unit minus variable cost for X. So what is the variable cost? 160 is the material cost. Variable overhead is 8. So 168 and 4 into 6 is for how much it takes for the X variable, and 8 into 6 for the B department. So 168 equals to 168 plus 6 into 4 24 plus 8 into 6 48. This is the total variable cost for contribution margin will be 312 minus this 240 72. So this is in the same manner you will calculate contribution margin per unit for all three. After calculating it, we have to check how much time it is taking for the department A, as it is given that there is a constraint in supply of labor in department A. So for department A, 6 hours is needed by X. So for calculating contribution is better for Y. So if nothing was given, Y should have been maxed out. Like 16,000 of Y should have been produced, right? But as it is given that A has constraint in manpower, we'll check for per hour how much it is making. So to make 72 contribution margin, we need 6 hours of A, right? So per hour we are getting 12. To create 10, 100 contribution margin, we need 10 hours of A, means 10 per hour, and for same 8 per hour. So here you can see that X is most profitable per hour basis. Rank is 1 and 2 and 3. Now the rank is given, and now we have to calculate how much is total manpower. So annual production at present in units, if you check, this will give you the total manpower, and how we can calculate it is 1000. Now it is generating 1000 of 10,000 of X, 12,000 of Y, and 20,000 of Z. So for 10,000 of X, it needs into 6, 6,000. 12,000, it needs 10, so 1,20,000. So 60,000 and 1,20,000 is 1,80,000. And for Z, it needs 5 hours and 20,000 units, so 1 lakh. So sorry about that. So total 2,80,000 of manpower. Check, this is the formula. So these are the total manpower we have. So as the rank of X is highest, we will make all of how much unit we can make for it, which is 12,000. For 12,000, we need 6 into 12,000, 72,000 hours, right? And in 72,000 hours, what will be our contribution margin? Per hour it is 12, so 72,000 into 12, or what is 72,000 into 12? Yeah, same. So 72,000 into 12 or 12,000 into 72. And for after that, how much? So total hour is lost by 72,000. How much hour we have left? 280. Sorry, we have 280 minus 720. So this is left hour, right? After the rank of Y is second, so 16,000 will make. So it will cost us 1,60,000 hours. So how much we left after the Y is minus this. So 48,000 will be left with. So that we will go do for Z. So for Z we have 48,000 hours left. So how much it will make per Z? It takes 5 hours, right? So total it will be 48,000 by 5, 9600. And then calculate corresponding contribution margin to calculate total contribution margin. And for the previous, we can just calculate 10,000 into 72, 12,000 into 100, and 20,000 into 40 to calculate the previous. And we have now current, and difference is extra. Now, the cost data of the previous month is below. Variable cost, direct material, direct labor, overhead, fixed manufacturing costs, fixed marketing cost, and total cost. PPO Limited has received a special one-time only order. Give me one. Yeah, so PQ Limited has received a special one-time order of 2500 medals at 120 per medal. Yeah, I remember this one. I have done it differently than what ma'am did. So if you understood what ma'am did, skip it, I will say. Because I have done it in a easy way, I guess. You should not skip this. Skip the ma'am's one. Okay. So PQR Limited has received a special one-time order of 2500. Now PQR Limited accept the special order or not? Explain. Right. So we have to calculate What is our variable cost per unit? So total variable cost is this plus this plus this, right? Suppose the plant capacity was 9,000 medals. Okay, the capacity is given 10,000. Okay. 10,000 is given, right? So if we sum all three and it by the units, we'll get our variable cost per unit. And these are the fixed costs. It will happen anyway. So the company has current production and sales level of 7500. Okay, we have 7500 capacity. We have sold, so it will be 7500. So 84.93 is our current variable cost. Okay, current variable cost. Now 7500 is produced currently and it has capacity of 10,000 and the current domestic market price is 150. Now should we sell it at 120? Yes. Why? It is more than variable cost. So economics term 1 said that if it is more than variable cost, we will earn some contribution margin which will cater to decrease like for the fixed cost to decrease, like we will earn something so that we can give the fixed cost. So yes, number one is yes. Second is suppose the plant capacity was 9,000 medals instead of 10,000 medals this month. Decide to whether accept us the special order or fully reject it. Now if it is 9,000 medals, now in market we can sell 7500. If we are taking the order, then in market we will sell only 6500 at cost of 150, right? And 2500 at 120, right? This is the option one. If we take it, if we take yes, if we don't take. If we don't take, we will just sell 7500 at 150. Okay. Now we have to calculate, let's say fixed cost will be always there. So we don't have to look at fixed cost. Just forget about the fixed cost. Just you have to calculate how which contribution margin is bigger. So for this scenario, 6500 we are selling at 150 rupees, right? So per unit, what will be the contribution margin? 150 minus the variable cost, 65.07. And for the 250, it will be 120 minus contribution margin. So this will be contribution margin per unit, and these are the unit. And for here, it will be totally 150 minus the variable cost. Okay. So what will be the total? Equals to 6500 into, I'll just write it here, and 2500 this. So equals to, so this is the total contribution margin. Okay. Now for no case, it is 00 into 65.07. Okay. Why I feel like I have done something wrong? Did I? So this much extra they will earn 22,000. Yeah, I have done right. So this much extra we will earn more. So it's done just by this calculating this. I don't think we have to do all these things also. And if you check what ma'am did was a pretty explain thing or something. I guess this one, yeah. So if you see the final answer will be same. What is the difference? Did she calculate? I don't know what she did, but yeah, I have done it like this. Now, okay, session for this one is, I guess, I don't know. Mm, Yeah, I have very much faith in me that I can be able to do this one. But I mean, for material consumed, raw material purchased, plus opening minus closing, and this freight inwards was something about, I don't know. So that will be material consumed for direct labor wages for the factory workers, contribution towards their provident fund, and production bonus. These are all direct labor. Direct expense is royalty paid for production, amount paid for power and fuel. You can just go through one by one and make a reason out of it and hope that you can do it in the exam. I don't know if she will give a cost sheet problem, this kind of problem. But yeah, material, direct labor, direct expense, calculate then prime cost, all three of that. Then add the factory overhead to calculate gross factory cost. Then calculate the factory cost, quality control cost to calculate cost of production. Then add the add the opening stock of finishing good and less closings to get COGS. Then add the administrative overheads, selling overheads and distribution overhead to get cost of sales. I have no idea how all of these are coming. So you can see freight inwards. I don't know what this is. I forgot. You can just Google it. Royalty paid for direct expense will be royalty paid for production, amount paid for power and fuel. Paid for power and fuel is direct expense. Okay. But electricity is indirect, right? I have no idea why then it is power and fuel is here because we cannot directly assign it to a single unit. It should be indirect, but it is what it is. Uh, Amount paid to purchase of mole life is equivalent of 2 production years. So we'll take 1 year. Job charges paid to job workers. They didn't touch the product. That's the reason. Then after that, just go through it one by one. I am not doing it. Yeah, so for problem 15, I have done it, but I'll show it in what ma'am have done. So you can just read the problem, pausing the video for 2-3 minutes. It's a bit complicated. But after calculating, we know that 200 are totally completed, right? So at 200 rupees per kilo. So that cost is material in hand is 40,000 and 650. Okay, sorry. Materials in hand is 200 kgs, which means 40,000 rupees. right? Only 200 asset. So material in process is 650 kgs at rupees 200. So material in process is this much, to 650 into 200. Now proportionate cost of scrap. So we know that 50 kg from the 1000 kilo is scrap. So from the 950 kilos of non-scrap material, we get a valuation of 800 rupees. So material in hand is 200 and material in process is 650. So total 850 is our material in total, right? So for 850, how much it would be? For 950, it is 800. For 850, it will be 716. So we are getting that back, so minus. So we will get material cost. After that, labor cost is given 20, 25, 20, and 30. Up to first operation is 600. So 600 into 20 will be 12,000. 400 into 20 plus 25. It is given as sequence. So at operation 1, 600 is waiting. Operation 2, 400 is waiting, working. So this 400 also went through that operation 1, right? So we have to include that also. So 400 into 20 plus 25 equals to 18,000. 300 into 20 plus 25 into 20 equals to 19,500, which is 49,500. And the company recovered factory overhead expenses on the basis of direct labor cost, and the current overhead rate is 80%. So it said that it will be on direct labor cost and it will be 80% of that. So calculate that factory overhead total. So adding all of three, you'll get this much. Okay. Okay. Problem 16. Went to the problem first. Okay, a manufacturing company process production through two departments, one machining, one finishing. Overhead rates are predetermined on the basis of machine hours in the machine department and the direct labor wages in the finishing department. So it was arrived at the finished machine in machine department. Direct labor wage is 3600, factory overhead is 8 lakh, direct labor hour is 2400, machine hour is 2 lakh, finishing department it's 4 lakh 6,000 and 5,000. Now what we have to do is the cost sheet for job like this is indicating material consumed is 50, direct labor wages is 45, direct labor hour is 24, machine hour is 15. Finishing department, this is this. Assuming the production order number consisted of 10 numbers of part, prepare a cost sheet showing the unit cost for the part. Okay, so basically what we have to do is calculate factory overhead. Material is given, direct labor is given, material is given, direct labor is given, direct labor hours are given, and machine hours are given. So you have to calculate factory overhead. So for machine department, it will be given as machine hours. So for machine department, it was 2 lakh hours and factory overhead was 8 lakh. So 4 per machine hour. Now our machine hour is 15. So it will be 4 per hour means 60 rupees. Okay. And for finishing department, it is dependent on the direct labor in the machine department, the basis of machine hours in the machining department, and the direct labor wages in the finishing department. So direct labor wages was 4 lakh and factory overhead was 6 lakh. So 1.5x. Now here direct labor wages is 40. So it will be 1.5 into 40 is to 60. Okay. So nothing to do with direct labor hours because it is given direct labor wages. So now add 50 plus 45 plus 60. Have I done it? Yep. So here it will be 60 and here it will be 60. Now they said we have from this we have created 10 units. So we need one single unit. how much we have it has costed, right? So it is, if you see, just 50 plus 45 plus 67 plus 262 rupees is total cost, and 10 number of part are created. So by 10 you will get 26.2. Now problem 17, rate of company to manufacturing. Same, but different. So predetermined, it's pretty much same. You can see you have to just calculate how much manufacturing overhead is depending on direct labor or machine hour for this job. Where material is given, labor is given, only the manufacturing overhead we have to calculate. So if Redoc uses a predetermined plant-wide overhead rate with the direct labor hours as a local allocation base, how much manufacturing overhead would be applied for to job A200? For A200, if plant-wide predetermined plant-wide overhead is allocated with direct labor hours. So direct labor hours, if it is 2500, manufacturing overhead was this. So we have to calculate the rate for all three. 4 lakh by 15,000 and 7 lakh by 40,000. And then how much hour we have used here, we have to calculate. So let's see if I have done it or not. So what will be the value of manufacturing overhead for direct labor for assembly is by direct labor, which is 12. Okay. And in this case, we have used 10 hours. So 12 into 10 is 120. Again, for this, it will be 40,000 per 15,000, 4 lakh by 15,000 is the total. So it is the per hour rate, and here we have used this into per hour. Here we have used 2 hours, right? So 2 into it. So this. Similarly for this. So in first case, these are the three job elevation. Okay. If Red Hawk uses predetermined departmental overhead rates with direct labor hours as the allocation base in assembly and machine hours as the and machine hours for allocation in fabrication. Oh, okay, it's total, it's not third one. Sorry. So we can just create these two and it should be the sum of it, not the rate. So this should be 20 plus 53.3, 173.33. So in the second question, it is given that for assembly, it is again 12. So 12 into 10, 120. But for fabrication, it uses machine hours. So the rate will be 4 lakh by 50,000. 8, and now here they have used 7, so 7 into 8, so 7 into 8, 56. The total is 176. Okay, so assume that TRADOC uses the departmental overhead rates mentioned in the requirement 2, and the job A200 includes 50 units. What is the unit product cost for job A200? So now we have to add all the, so 176 plus 110 plus 50 plus, okay, so 160 plus 115 and plus 176. How much will it be? 160 plus 115 plus 176. Sorry, it will be plus. And we have 50 units. So just divide it by 5. I guess 9.02 is the answer. Sorry, 50. 50 unit. So 9.02 is per unit. Let's see, check with MAMS solution. Yep. Now the next one. So let's continue for session 6. We didn't do problem 18, 21, and 22. I think those were given at the end for the extra uh, those kind of questions. So I'll do it in that sheet only because I didn't do it here. So for this, I think only 19 and 20 was given. So let's calculate for that only. Okay. So how I did it is the total over cost is given this value actual, and how much we estimated is given with this formula like $25 per hour and 19,400 machine hours. So multiply these two, you'll get 48500. So this was our estimation and this was the actual. So we overvalued it by 12,000. So now we have to create the cost sheet. If we have to, what we have to do is this is the beginning inventory plus in purchase of raw material minus ending inventory and minus indirect materials. So this will be our total what it is called direct material cost. So why we minus indirect material subtracted that is because uh, that is already taken in overhead, right? So we cannot take again, it is in the material cost. Then the direct labor cost, and if we add those two, and this is sorry, and this is the our estimated overhead. So if you add these three, you will get cost of manufacturing. With that, add the beginning work in progress and subtract the ending work in progress. So you will get unadjusted cost of goods manufacture. And then whatever was overvalued, we will subtract it in the end of the year. And whatever is got we got is adjusted cost of goods manufactured. Let's see what ma'am did. Yeah, same answer. So okay, for the 20th one, I'll just read the problem once. Yeah, so I read the problem. It is a simple one. So overhead rate is 18.2 per direct labor hour, right? And it was based on estimate of 2,18,400 of total manufacturing overhead on an estimate of activity level 12,000. So for 12,000, it was 18.2, and the total estimate was 2 and $2,18,400. Now the company's actual is 215,000, and what was the estimation was at a rate of 18.2 on direct labor hour, which is 11,500. So 11,500. So this is our estimation, and this was our actual. So our estimation was less. So we undervalued. So this 5700 is the answer. How will it impact the gross margin of the company? So it we have to remove this 5700 from the gross margin because whatever we expected, we incurred a cost much higher. So we have to remove it because we undervalued the cost. Uh, let's see what I'm saying. Yep. Now, okay. So after that, PC problems were provided, I guess. Yep. So for that, the first question was this, right? So here we have it is given that 240, the total units that passed through each process were 240 for the period, and these three are given, and indirect expense is given, and it is apportionate on the basis of wages, right? So it is based on labor, how much labor cost is, right? So 80,000, 80,000, 2 lakh and 60,000. If we add these three up, 3 lakh 40,000. So total 3 lakh 40,000. For 3 lakh 40,000 wage, 85,000 is the indirect expense. So for 80,000, what will it be? That will be the labor cost for process one. That's how we can calculate labor cost for each of one. Process one, it will be 20,000. For process two, it will be 50,000. And for process three, it will be 15,000. Okay, after calculating this, we just have to do a cost sheet based on per unit basis and total. So per unit, tool material is 1500, labor is 80,000, and other expenses 26,000, and indirect expenses is 20,000. So, and per unit it is divided by 240 because 240 was a total unit number. So you will get this. This is the debit side, and for the credit side, it will be by process 2. So we will be sending it to process 2. In the process 2 debit side, the first one will be from process 1, and then 50,000, 2 lakh, and 72,000 and 50,000. This will be written, and by 240 you'll get this. Then add all up, and it will be going to the process 3, and process 3 also to process 2 will just start from there, and then 20,000, 60,000, 25,000, and 15,000 by 40 you'll get these values, total unit per unit, total per, and by finished stock account this is the value. Okay, I guess we have to do this much only. Anything else? No. Yep. So let's go to problem 2. A product passes through process 1 and 2. Material issued to process 1 amounted to 40,000 minus 30. Manufacturing overhead 27,000. Normal loss anticipated was 5% of unit. 4750 units of output were produced and transferred out from process 1. There were no opening stock. Input raw material issued to process 1 were 5,000 units. Scrap has no realizable value. You are required to prepare process 1 account value of normal loss and unit transfer to process 2. Process 1 account 40,000, 30,000, 27,000. Total units 5,000. So total will be this. Now here the total will be 97,000, but 4750 units of output were produced. So by process 2 we will provide 4750, and loss is the other part, which is I guess 250, which is I think 5,000 into 0.055% also, yeah, which is given 5% of the input. So you can add it up and both side will be same, and units are 5,000 and total is 97,000. So multiplying it with 85, why though? Process 1, you are required to prepare process 1 unit value of normal loss and unit transfer to process 2. Yeah, I don't know, did ma'am do anything about this? Yeah, until this, right? Value equal to normal cost minus total realizable value of normal loss by total input unit minus normal loss unit into unit transferred. It's 97,000. Okay, yeah, that was not necessary, but this formula I think it's hard to remember, but total cost minus total realizable value of normal loss by total input units minus normal loss units into units transferred. So here it will be 97,000 minus 0 by 5,000 minus 250 into 4750. So 4750 and 4750 will be cancelled out. Okay, okay. For the problem 3, pretty much same. Scrap has realizable value of 2 per unit. So here it will be 97, here it will be 97, and it will be 2050 and it will be 4750. Now for 250 value is 500. So this will be difference of, you know, these two. But if you are using the formula what was given is 97,000 minus scrap value by equals to divided by unit produced minus unit minus loss into total processed. So it will be 96500 only. So the formula, it will be 96500 by 47500 and into 4750. So it will be 96500 only. So that will be our by process. P4 is given as same 250 and 4500, but here it is 4550 units are produced. So we know 250 it's 500, right? Now this value how we can calculate is from the formula equals to 9700 minus 500 and three terms are there. Another one is 5000 minus loss, and here it is this into 5000 total process to the process 2 is 5450. So equals to 9650 into 4550 by this. So 922,436 point this value. So the x left out value will be this 4063, or you can calculate it as here in place of 54500 you can give how much the abnormal is the left out value. So it will be 4036.16. Okay. Now another one where it is given that material loss anticipated about 5%, but 4850 units of output were made. Right. So normal loss is 250 and 500 is our total. So again we have to calculate 5000 minus 250 into, okay, first one was 97,000 minus normal loss resale minus realized value. This into this by process. So sorry, this into this, so equals to this into this by this. So 98,531. So this will be total. Now we cannot write abnormal here because after the add up, this is higher than this, right? Right. So for abnormal loss, it is not loss, it is gain. So what will be the gain is, first of all, calculate how much this two adds up to. It will be adding up to 5100. So 100 extra. So for 100 extra, how we can do it is just remove this value to 100 and 2031 will be there. So for 100, 2031 will be here. Okay. And after that, we can again write the total is 5100 and the total will be matching now. So value of normal loss is equals to 5%. Okay. Okay. Done with PC problems. Okay. For then session 9, it gets complicated. So if someone is even, watching this, listen carefully. Okay. We have opening work in progress as 1000 units, which are 60% complete, which costs us 1,10,000. So per unit it costs 110. Unit introduced was 10,000, which costed us as 19 lakh 30,000. So per unit 193. Transferred to next process is 9,000. So total 11,000 was there at the beginning. Next process we have 9,000. Closing work in progress is at 800 units, so it's 75% completion. Okay, Normal loss is 10% of total input, including units in process at the beginning at 10%. So what is that? It's 10% means 0.1 into total unit was 10,000 plus 1,000 at the beginning. So 1100. So how much is abnormal then? Total was 11,000, 10,000 minus plus 1,000, right? From that, 9,000 was sent to the next process, 800 is work in progress, and 1100 is net loss. So 100 is abnormal. So this is normal loss, this is abnormal loss. Okay, now using FIFO, we have to calculate. Okay, now, not sure what are these, but okay, let's continue. So, statement of equivalent product unit under FIFO. So, that means transferred is 9,000. So we have to calculate from which batch how much is provided. So opening work in progress was before there at the very beginning. So these 1,000 were first processed, right? Then the new introduced ones. So those 1,000 were 60% completed. We had to calculate 40% of it, right? So its equivalent production is, so units were 1,000 and its equivalent production 40% was needed. So around 400 equivalent production we had to do. Also the next 8,000 was from this 10,000, right? And 8,000 we had to do 100% of the process. So 8,000 into 100% is 8,000. So 8,000 equivalent unit. Now closing work in progress was 800% units, which we did 75% of the completion. We did. So we did around 800 into 75%, 600 units of work. Net loss we don't consider because it got lost. Abnormal we have to consider because 100 we have to bear this with 100%, which is 100. So here total was 11,000. Output units is 11,000, but we have done production of 9,100, right? Right. Now, if you understood this much, we have to calculate per unit how much it costed. So you have to calculate how much cost we incurred. So 1930,000 we incurred, right? For the units introduced at the very beginning, and 1,000, 11,000 and 11,000 is acha, less scrap. So 1100 was our normal loss, and that loss was sold at 100 10 rupees per unit. So 11,000 was scrap. So total cost was this 1990,000. Now this much cost was incurred and equivalent work we have done is 9100. So per unit it was then C27 by 9100. This is the per unit cost per equivalent unit, whatever. Now we have to do this table, which is equivalent unit kind of a thing. So first of all, for opening stock, the cost is, I think we are going in the right direction. I don't know. In progress completed during. Yep. So we have to calculate how much value we have. At the very beginning, opening work in progress was 1,000 units, which was valued at 1,10,000, right? Now we have done 40% of its job. 60% was done, right? So 40% we have done. So 1,000 into 40%, which is 400 unit we have done, and per unit cost was 210.87. So 400 into 210.87 is the value which was done for the opening work in progress. So total value for this 1,000 unit is addition of this, which is 19,435.1. Now unit introduced was around 8,000 from the next stock, and from that per unit cost is 210. So this is the unit introduced for the 8,000, and closing work in progress is 800, in which 75% of job we have done in this process. So around 600 equivalent production. For this 600 equivalent, the cost per unit is also same, and the total cost will be this. For abnormal 100, it will be again multiplied and we will get abnormal cost. And normal cost we don't consider because it is lost and it is going to scrap, right? So that's why. Let's check if it is similar. I guess so. And now for the, I think ma'am did the WA only. So it's similar. Yeah, it is almost similar, but it is only using weighted average method compute the equivalent. So we have to do a weighted average kind of a thing. So so this will be same. Total transferred unit is 9,000 and 100% we will take as equivalent to calculate 9,000. Okay, and with that, closing work in progress is 800, whose 75% we have done. So 600 unit production, 1100 we won't take, abnormal is 100, again same. So total equivalent production we have done is 9700. Okay, now here we have taken that whatever we have transferred, we have given 100% equivalent of that. So due to that, the cost will be also different. Here the total cost will be opening in work in progress plus cost of process minus scrap, and then the same thing, just divide it by that, you will get the cost per equivalent unit, and then for 9,000 it is into, you will get this. So this is the value of 1,000 output. No, this is wrong here. This is the value to what you processed in the process 2, and then closing work in inventory 600 equivalent into it, you will get closing whatever value you have put into the closing work in progress, and abnormal loss is this much. Okay, WA2 we didn't do. I think ma'am did it in the last class. I'll check there. Okay. Okay, I skipped the ABC ones. I'll do it. So this is the problem. Just go through it carefully. So before the, I guess in the solution session part 6 or in some session, we used to do it in the traditional way where it was written that take labor hours as the driver or machine hours. But in ABC, what we do is we divide what is from where and use that thing. So payroll taxes is direct labor hour, machine maintenance is machine hour, purchasing department labor. So it was, there were some confusion as it is purchase, it will be coming under purchase order or direct labor hours, but finally ma'am said it will be purchase order because it is related to purchasing. Then perks or fringe benefits, which will be going to the direct labor hours. Purchase again, it will be PO. Equipment depreciation will be because it is related to machine, it will be machine hour. Electricity always machine. Unemployment insurance, it is related to labor, so direct labor hour. So after dividing it with which is what, just add the all DLH, all add all the MH and add all the POs. Now labor hour is divided in A and B of 4 is to 6, right? So labor hour is 40% will go to product A and 60% will go to product B. So if you calculate 40% of 4500, it will be in the product A and 60% of it will be going to product B. Also same with machine hour, it's 100 and 150, right? So here it will be 100 by 250 and here it will be 150 by 250. So 100 by 250 into 2500 will be going here. So you have to just how much percentage is what you have to calculate. So how much it is by 250. 250 is addition of 100 to 150. So zero point 0.4 and again it will be also zero point 0.6. It's just 150 by 250. So zero point 0.4 is to 0.6, right? So and here it is 0.5, zero point 0.5. So 2500 if you divide it in zero point 0.4 and zero point 0.6, you'll get 1000 and 1500. And 4250 you will divide it in zero point 0.5 and zero point 0.5. So it will be 2125 and 2125. The total sum is this, and these are these values. For ABC2 compute, okay, okay, I'll just give it a read once, then I'll continue. Sorry, I forgot where I was, but I'll, someone just told me we have to do all of this in paper. Realized, okay, so I guess we can write here. We can, no? Okay. So I'll just show it. So the question is, we have provided this, then these things. So here overhead is given 0 and total counts is this much, and also concluded 50,000 and 1 lakh of the company's advertising expense could be directly traced to B trivial and defensible. Now advertising comes under AC and H. You know, it will come next one. So we have to do a traditional and we have to do a ABC, and activity post cost pool is given like this or ABC. Now what we will have to do is for traditional 6,08,000 is invoice, and in traditional we get traditional direct labor. So the rate is 608 by 304 2. The part 2. So uh, for 2000, 2 lakh labor, MOH will be 4 lakh into 2, and for this 1 lakh 4,000, 2 lakh 8,000. We can just divide it like that. And the other cost, so sales, we can calculate from 70,000 into 20 and minus the direct material, direct labor, MOH, we calculated 2 lakh into 2, 4 lakh, 4 lakh. So we will get, and after that, if you see, we will get the product margin. And same for the T500. If you calculate 17 for 500 into 40, you get revenue minus direct material, direct labor, MOH will be 104 into 2, 20400, 20800, and you'll get product margin. If you just add those two, you'll get these values. And now activity. Activity based, we have this value, right? So for 213,500, we only can allocate 152,500. So what will be the rate? 213 by 1.4. So 1.4 is, so for 152,500, which we can trace, the total invoice is 2,13,500. Now for B300, 90,000 we can trace. So how much it will actually be effective in the 213,500? We will do this 90,000 into 1.4. Do we get this? Whatever it is. So I'll just, what you have to do is again revenue, direct material, direct labor. Now material, they said that 50,000 and 1 lakh we can allocate, so we allocate that. Now machining will be 90,000 into 1.4, which is 126,000. Now what you can do is 375 of 157,500, we can, we know that we can associate it in a 75 is to 300 ratio. So for we can test 375, but the total is 157,500. So for each traceable, what is the rate? Yeah, it's 420. So for V 300, then how much it is? 75 into 420 and 300 into 420. Okay. So it's basically 2,13,500. We are dividing it in a 90,000 is to 62,500 ratio. Okay. Now this will be 75 into 420 will be setup cost, and then same you have to do it for 1,20,000 in one and one. So you have to just divide 1,20,000 in 1:1. So 60,000 per, you know, product sustaining. So after all this, you will get this value. And for T500, you will get this value. And you will get this value. After that, some other costs are there which are given as this and the MOH, which we cannot trace. So we'll just write it down at the end. And also uh, this ACNA, previously it was 55,000. Now what we have to do is we will deduct the 1,500, 1,50,000 also, because they have already added it in here, so we cannot add it again. So remove it from there, and the other thing we cannot get, so we'll write it here. Okay. So this is final, which will be always same with this. So here we go. This is done. Yeah. So next is DC and DM. I think DC and DM questions were easier than the rest, and I'll just go through one by one. So just read the problem. So which one we should take? So for outside we have to do 3420 plus 3.7, 37.9. And for our own in-house, we have to pay the 5.6 anyway. So the variable cost we have to calculate, which is 14 plus 22.5, that's 6.5. So we should do in-house. Continue and discontinue. Healthy having some kind of functionalities of smartphone items and sales, hostel goods, gross profit is 340, operating expenses 5 lakh, and gross from this. It is estimated that 25% of the cost is fixed, means 120, and 40% of the operating expenses fixed, which is 2 lakh. Use differential analysis to determine whether continue manufacturing and selling profit. So we have to calculate variable cost. This is fixed, right? So how much is variable? This much. This is fixed, means how much is variable? This much. So total variable cost is 660. So if variable cost is less than sales, that means this 60,000 we are profiting, right? Because fixed cost anyway you have to give. So we should continue. Harper company purchased equipment of 40,000 several years ago. It currently has a book value of 15,000. Harper can sell the equipment for 10,000. The company would have to pay a 2% commission on the sale. Alternatively, the company could lease the equipment to Allen Company for 2400 for each of 4 years. At the end of the lease period, the company could return the equipment to its manufacturer for $100 of cash, Scrap. In both cases, it will cost Harper Company $900 to destroy the equipment site in the factory once it is removed. Use differential analysis. So we can sell it for 10,000 with 2% of commission means 200 commission. So the total will be 9800 our income from that, right? Second option 2400 for 4 years, which is 9600, and after coming $100 of scrap, so 9700. So which is better? 9800. So that one. Morning cost coffee in batches of 5,000 pounds. Material cost is 580 per pound. The dark roast coffee can be sold without further processing for 970 per pound or may be processed further to yield dark roast decaf, which can be sold at 12.10 per pound. The processing into decaf requires additional cost of 7480 per batch. The additional processing will also cause a 4% loss of product due to evaporation. So if we don't do it, 5,000 into 5.80, which is this much is our cost. Our revenue will be 5,000 into 9.7. So total profit will be 95000. Now if we do batch processing, okay, what will be our revenue is 4% loss of 5,000 means 5,000 into 0.96. 4800 will be our unit number, which we will sell at 12.10 per round, right? 4800 into 12.10 equals to 58080. Now the total cost is 5,000 into 9.7, sorry, 5,000 into 5.8, okay, and plus 7480, which is this much. So the profit is this profit is higher, so this one, decaf one. This company is considering selling an existing piece of equipment 75,000 and replacing it with new equipment that will cost 1822. The old equipment cost 2 lakh and currently accumulated depreciation of 1,20,000. The estimated annual variable operation costs for next 6 years are 21,000 for the old equipment and 6,000 for the new equipment. Okay, if we keep it, the cost was 2 lakh. Accumulated depreciation is 1,20,000. So current book value is 80,000 and which we can sell at 75,000, right? And operational cost for the next 6 years are 21,000. So total at 126,000. Okay. Okay. If we buy new one, we will incur a loss of 12,000 for cost and old value will sell at 75. So total is the cost we will get is minus this much, right? And also 6 months, this is 6,000. So 6 into 6, 36,000. The total cost will be 107 plus 36, 143,000. And here the top cost is 126,000. Okay, these are not needed. I did it. I don't know. I did it because of other things. So these are the opportunity costs which are already, sorry, these are the sunk costs which are already done, right? So we have to see for the next 6 year how much we have cost. Okay, so 17,000 profit if we keep the old one. Sparked up company manufactures countertop toasters oven and $60 per unit. And overseas wholesaler offer to purchase 5,000 toaster ovens for $36 per unit, which would be additional production beyond the spark top had planned for the company has capacity to process this special order. The variable manufacturing cost per unit is $25 and the fixed manufacturing cost per unit is $15. A tariff of $800 charged to the company for shipping each batch of 5,000 restaurants. Okay, so if we don't do it, there is no problem. If we do it, the revenue will be 5,000 into 36. The cost will be 5,000 into 25 plus 800. So profit will be this much. So if the profit is in positive, then do it. My God, did she do it that day? I don't remember. Nope. So I will also not do it. What is this question? I'm not going to do it. It's too much. Then sorry. Okay, last one. Additional problem. So value contribution per unit. I don't know the problems are. Let me just go fix the solutions. Problems. This much is given. So what would be the revised net operating income per month if the sales volume increased by 100 units? 3500, payroll expense 20, 15. 15. So contribution margin is 1500 unit, 1500. 15,000 into 1500 is 1650, 500. What will be the revised operating income? The sales volume decreased by 100 units. 100 unit decrease means contribution margin per unit is 15. 15 into 100, 1500. Net operating income will be 1500 minus 15,000 minus 1500, 15,500. What will be the revised net operating income per month if the sales volume is 9,000 units? Revised net operating income 9,000 units means loss of 1,000 contribution margin. So 1,000 into 15, 15,000. So loss of 15,000. So now it is 15,000 minus 15,000. So 0. Last month when only 15,000 unit total sales were 2 lakh. Total variable expense were 12000 and fixed expense were 65,000. So 2 lakh were the sales, 1200 variable expense, 50,000 is the unit. So per unit cost, the selling price was 4, variable cost was 2.4. Contribution margin was per unit 1.6, and which was 80,000 and 65,000 was the fixed expense. So net profit was 15,000. Now what is the contribution margin ratio? Contribution margin ratio is 80,000 by 2 lakh, which is 4%, 40%. What is the estimated change in company's net operating income? It can increase total sales by $1,000. So if it increases the total sales by $1,000, contribution margin is $1,000. So if sales is increased by $1,000, so more of 250, you know, one unit is $4, so 250 unit will be more sold. For 250 unit more sold, what will be the variable expense incurred from that is 250 into 2.4, which is 600. So if 600 is variable expense and profit is 1,000, sorry, revenue is 1,000. So profit from that is 400. So 400 is the answer. In what company installs this. The company's degree of operating leverage is, we know contribution margin by net operating income, so 4.8. Using the degree of leverage, if 5%, 5 into 4.8. Verify your estimate from part 2 above by constructing a new contribution margin format income statement in 5% increase in sales. 80,000 to 5%, 84,000, 32,000 to 5% increase. This contribution margin will be this, total will be this. Machine costing 1 crore is expected to run for 10 years. At the end of this period, its scrap value is likely to be 9 lakhs. Repairs during this life is expected to be 18 lakhs. And the machine is expected to run for 380 hours. Its electricity consumption is 15 units per hour and rate per unit being 5 rupees. The machine occupies one-fourth of the area of the department, which have 2 point less. The foreman has devoted about one-sixth of his time to the machine. The monthly rent of the department is 30,000 and the lighting charges around 8,000 per month. The foreman is paid a monthly salary of rupees 19,200. Assuming insurance 1% per annum of 1 rupees 1 crore and the expense on oil are uh, oil etc. are rupees 900 per month. So total is 1 crore per 10 years. So per year it's 10 lakh and per month it's this value. Okay. Scrap is 9 lakhs per 10 year per year. Sorry. Yeah. And so per month it's 7500. Repair is 18 lakh per whole lifetime. So 1.8 lakh per 10 year and 15,000 per month. So this is we will get so minus. So these three are the total cost with this. Now using it for 380 hours for 365 days, right? So the machine is expected to run for 380 hours per year. So in 365 days, we'll use it for 380 hours. So how much we will use it per month is 30 into 4308 65 by 360 hour per month, and it will cost us is 360 into 15 unit per hour into 5 rupees per unit. Okay, I think 30 into 30. Yes. Why is it 37? Okay, I just calculated in by month, so it's coming. We are not taking days, we are taking months only. So for 380 in whole year, so in every month 365. So the total cost will be 365 into 15 into 5, which is this. Now electricity consumption is 2 point of 10, so 1 by 5th of 8,000. Wait, machine occupies one-fourth and has 2 points out of 10 points for lighting. So 1 by 5th. Okay, lighting charges amount to rupees 8,000. So 1 by 5th of 8,000 is 1600 is 6,000 is, yeah, lighting value is this. And this is, I think, for monthly rate 30,000 and it is one-fourth. So one-fourth of 30,000, 7500. Okay, now what is left? Monthly salary 19,200. So it's one-sixth. So 3,200 is from salary. Okay, so these are the values. Now with that, what we have to do is insurance for 10 years per 1 year. So per month this is, so that also you have to add, and per month 900 extra is also we have to add. So the total sum is the total cost per month for that machine. Okay. So we have to calculate hour rate. So just divide it by 365 because per hour it is going to run 365 hours. So we'll get the hour rate. The following information has been collected from cost records of all small companies for the previous years. These are given. You can check the problem once. Okay, this much no question. Fine. Okay, this much is given. So these were not given. From this, nothing was given. So yeah, a proportion wage using direct wages, labor hours, and machine hours. So it's just calculating the overhead in different ways. So overhead is 1,60,000. So if we use direct wages, it will be 1,600 by 2 lakh point 8. If it is labor hour, it will be labor hour is given 1 lakh. So 1 lakh 1 lakh 60 by 1 lakh is 1.6. The machine hour is 40,000. So 1 lakh 60 by 40 is 4. These are the rates given. Now what is given is should be the price quoted for a job of 2000 labor hours at rupees 3 per hour. So direct labor is 6,000 for all. Direct material is also given 10,000 and direct material everything is given. So only we have to calculate work overhead. So using direct wages, it's zero point 0.8 of direct wage. So it will be zero point 0.8 of 6,000. So it will be 4,800. So total will be this. Office expenses are given as 15% of this, right? So we have to again calculate this and calculate the 15% of that. That will be office expense. And then create the total. Now this is the total for the whole cost. Now we need 20% of profit on the selling price. So we have to have a selling price whose 20% is this. So how to calculate this is basically if you see how the formula is coming here is we have a selling price, let's say S, and it is said that profit is desired on the selling price as 20%. So selling price into zero point 0.8 should be this total. So because it's a profit desired on the selling price. So selling price would be total by zero point 0.8. So total is 24022. 24022 by zero point 0.8. This value. Similarly, for direct material, you have to do work overhead is for the current it is given is if you're taking labor hour, it is given 2000 labor hour. So 2000 into 1.6 is this value. So again, you'll calculate and it's 15% will be office expense, and then calculate the total, and then same formula. Similarly, this. Now, the following information is gathered for a company doing jobbing work. So, the company has to code for it's basically same as the previous one. So, material consumed, direct labor. So, nothing is given. So, we will take direct labor. Okay. So, total is 94000, 30,000, and direct wages for it will be 45,000. So material is 30,000, direct labor is 45,000. Factory overhead will be, so previously factory overhead was 24000 and total was 940, direct labor was 3 lakh. So the rate is 22 lakh 40,000 by 3 lakh. Okay. So which is 0.8. Now also it will be same. 36,000 should be 45,000 into 0.8. So this will be the factory overhead. Now, if we add these three, we'll get something, I guess this one. Yeah. And from that, we can use how it was previously, the percentage of office expense of 940. And we can do that also. And also we can take, as it was nothing was given, we can also use the direct labor as a part of office admin expense. So here ma'am used the total work cost. So it's basically 94,000 by so point 0.1. So for in this case, it will be again then if these are the values, yeah, these three are the values. Total will be this, and its point 0.1 will be this. So this is ma'am's answer, I guess. So 1465200. Now the company, is there anything about profit is given? No. So 1465200 is the answer. Yep. 2000 kgs of cardboard valued at rupees 8,000 were issued for the manufacture of medium-sized cartons. 240 numbers of medium-sized cartons weighing zero point 0.5 kg each were manufactured without any effect. So that's weight is 1200. 320 numbers of medium-sized cartons were damaged and rectification cost came up to 160. So 320 into zero point 0.5 is 160. Okay. And also 160 rupees rectification cost. 480 kgs of off-cart side of cart size were used for manufacturing small size carton. This would have amounted to rupees 1 lakh 1,000. So 480 again weights 1,000. We got it from that. And 120 was sold as scrap of 20. Okay. Now the total of it is 1960. So the 40 is loss, abnormal loss, I guess. And total board is issued at 8,000. So total completion is 1200 plus 160, 1360, right? And total cost, total issued cost is the sum of all this, and you will get this value. Okay, so this is the cost. These are the number of successful cartons. So 7140 by 1360. Okay, 1360 is total output, right? Okay, sorry, by per unit you have to calculate. So 1360 is kilo. In 1360, how much unit are produced is that 1 is 0.5, so 1360 into 2. So 2720. So 7140 by 2720 is 2.625 is the unit cost. Primer Corporation has provided. I think after this, ma'am has provided. Primer Corporation has provided the following data concerning the previous month's manufacturing operations. Prepare a schedule the cost of goods manufactured for the month, beginning, ending, beginning. So direct material 19,000. We can calculate beginning plus purchase minus in hand. So 42 minus 18 and also 5,000. 42 minus 18 is 42 minus 18 is 24. And from that 5,000 is indirect. So we will not take indirect 19,000. Now raw material. So it is coming from this four. Then direct labor is 58,000. This one. Then manufacturing overhead applied to work in progress is 87,000. And then the total will be this three is total manufacturing cost. Add work in progress beginning minus ending, you will get cost of goods manufactured minus fixed good beginning plus mine and minus fixed good ending, add cost of goods manufactured, and you will get unadjusted COGS. And under applied overhead. Under applied overhead is 4,000 at the end. We have to do to calculate the adjusted COGS. And the following data from the record of Mason Company. Prepare a schedule of cost of good manufacture, assume all the raw materials used in production. By direct materials, prepare a cost, schedule at cost. The direct material is RM purchased plus beginning minus ending. So purchase plus beginning minus. This one is direct material. Okay, it is given there. After that, direct labor cost, manufacturing overhead applied to WIP. It's basically same from the last one. Gross manufacturing cost, we will get by adding all three, then add WIP less closing, get cost of production, then finishing, good, add minus the closing, you'll get whatever the value, and after that you are decreasing the over applied because it is over applied to WIP is manufacturing overhead applied was 90,000 but it was 80,000, so 10,000 was over applied, so less it will get actual cost of goods. And profit loss account 524 is sales minus COGS, you will get gross margin. SG and A is given as 20300. It is basically selling expense and admin expense, and you will get net operating income. Following information is available during process one of the month of February. Production records. Production records. I'm seeing this first time by the way, so bear with me. Production records 4,000 units introduced. New units completed. New units introduced is 16,000 units completed 14,000. Units in process as on 28th February 6,000. All material use 33 or 1 by 3% complete for labor and overhead. Cost records rupees, work in progress, material 6,000, labor 1,000, overhead 1,000, total 8,000. And cost during the month is material 2560, labor 15,000, overhead 15,000, total is 5560. Average inventory is used and equivalent. So first we have to calculate for whole. So it's completed 14,000, we'll take 14,000 into 100% 14,000. Then closing WIP is 6,000, of which 100% material is used, but 33% labor and overhead is used. So for material you have 6,000 and for overhead it is this much unit. So total is 20,000, 20,000, 20,000 here around 16,000 unit. Now to calculate particular for materials operating opening WIP is given 6,000. Okay, and cost incurred during the month is 25,600. Total cost is 21600. Equivalent unit is 20,000. You will get cost per equivalent unit. Similarly for labor, opening was 1,000, in between process 15,000. So 16,000 and 16,000 units. So per unit 1. Overhead also 1,000 and 15,000 and per unit 1. So you will get these values. After that, we have units completed 14,000. So we have to calculate appointment total cost of this three. So 14,000 into this addition of this three is value of the units. For material, it's 6,000, value of closing work in progress, which is 6,000. So for material, it will be 6,000, but for labor, it will be one third, 1919, 2,000 basically, 2,000, 2,000. And what is this? So, okay, so equivalent cost for that will be 6,000 into 1.589480, and for this one, into this. I don't know how I will do it in exam. No, I'm unable to process these things. So this and all three will get total cost. Now process one account, total opening WIP is 4,000 and the amount for it is 8,000. Material is 16,000 bought, so total 20,000. And for amount it is 8,000. For 16,000 it is 25,600. And lever 15, this total amount is 63,600. Particular per unit says by completion 14,000 is processed, units completed, and 6,000 is closing, total 20,000. And the amount of cost is transferred units cost is this much, and work in progress unit cost is this much. So total same. Okay, this is I'm not going to do because it's late at night and I'm sleepy. This is for your homework.